Okay, so in the first part of the chapter, we talked about how to determine our beginning basis for our partnership interest. So we've got that established, but the thing about partnership interest is it changes over time. It changes throughout the year and from year to year. And so in this section, we want to talk about the types of events, transactions that causes it to change. So recall, our inside basis is the basis to the partnership. How much, what the assets are worth within the partnership. So if you think of it, you know, the partnership's balance sheet, this would be their, you know, their assets, their equity essentially, the partnership itself. And the outside basis is the basis to each of the partners. What value does each of the partners have in the partnership itself? When we're talking about the changing, I mean, both of them change over time. The inside basis is going to change based on the same types of transactions that happen for sole proprietorships with basis changes in assets. You know, we depreciate assets, and so as it get depreciated, then their basis decreases. We improve assets. As we do that, their basis increases. So with regard to our inside basis, it's the same concept as what we talked about in chapter 6 with depreciation and all of that. For outside basis, though, some different types of events happen that cause that outside basis to change for each individual partner. And it's all on an individual partner level, okay, this change. And this is what we're talking about here, is the basis of the partnership interest, meaning the changes over time in the basis of the outside basis for each individual partner. Okay, so we're looking at it from the perspective of the individual partner, not from the partnership. Okay, so we need to keep a running tab, and this is really the responsibility of each individual partner to track their basis. Oftentimes it's done when they get their, like if at the end of the year when they get their individual taxes done, or when the partnership taxes are completed, oftentimes the accountant who's completing those taxes will help to determine what that ending basis is. But we need that information because if the partner sells their partnership interest, we need to know what the basis is to determine any gain or loss on that part. So just like any other asset, if they sell it, and if the basis is $100,000 and they sell it for $200,000, well, now they've got a gain of $100,000, right? Conversely, if it's $50,000, now they've got a loss of $50,000 on their partnership interest, and they will have to claim that and pay tax on that, just like any other type of asset. We also need to know what the basis is in order to determine whether or not the partner is entitled to get a tax advantage for any losses that the partnership incurs. Because remember, that basis can't go below zero. And losses for a partnership reduce a partner's basis. So if the partner doesn't have any basis to begin with, and there's a loss from the partnership, then that partner is not allowed to take that loss. But we don't know that if we haven't kept track of what that basis is, right? So that's why a couple of instances why we need to know whether or not a couple of reasons why we need to keep track of this outside basis. If there's any other. Also, when a partner receives any non-liquidating distributions, this means distributions that don't affect their ownership percentage. So they get some money out of it, but it doesn't affect their ownership percentage. That distribution, if there's no basis, but they got money out, that distribution is going to be taxable to them. It's going to be considered a dividend. If they do have basis then it won't be taxable to them. And you can think of it in terms of, you know, if you buy a stock, say you spend $100 on a stock, we got 2 shares of stock. It's $50 for each share. So now we got $100 basis in that. If we sell one of those shares of stock and we don't have a gain or loss on it or anything, we're just getting our money back out of it. Kind of like a savings account too. When we're depositing money into a savings account and then we're pulling it out, we're not taxed on that because that's just our money that we're getting back, right? It's just that it changed location for a little while. It was in the savings account and now it's not in the savings account. It's the same sort of thing with a partnership. That you've invested in this partnership, you've placed your assets in this partnership. If you're getting a distribution and you've got basis in that partnership, you're just transferring your asset from the partnership to you. That's not a taxable, that doesn't create tax. But if you didn't have the value in that partnership, the basis in that partnership, and you pulled money out, now that creates a taxable event. So we need to know, if you've got basis, to know whether or not that distribution is going to be taxable as well. So what types of events increase and decrease basis? So, what am I talking about here? So separately stated items, even if they're non-deductible, will decrease basis. I don't know why they put this in here. All income, gain, expense, or loss items on that K1 will increase and decrease basis. So if you got income from like that box 1, ordinary income, you've got income in that box, you're gonna pay tax on it, right? We've determined that, it's on the K1, you're gonna pay tax on that. That is gonna increase your basis so that you don't have to pay tax on it again when you sell it, right? Any type of expense or credit, deductible expense, like if you have a capital loss, that would decrease the basis because you're going to get a tax benefit from that. Okay, so there is an order to all of these, and I'm going to go through. This is the one. This is the thing that I was really looking for here. I thought that was up at the top, and it would start with that. There is also an order for how we record these in the basis calculation. First thing we do is we start with our beginning basis. So when we purchased it, we established what our basis is. That's our beginning basis, at least for that year. We're going to increase or decrease our basis by everything except for losses. So income items would be included in that, any other credits, deductions, but not losses. Like if we had an ordinary loss, we're not going to count that yet. We got to count some other things first. Then we're going to reduce it by any distributions, any money that was taken out. This would include the release of liabilities. So we talked about, you know, if the partnership had taken on liabilities when we acquired an asset, if we are released of those liabilities, you know, you're no longer responsible for that share. That's just as if you received a distribution, because now you don't owe the money, right? So that's why we're not going to include that. We are going to include that here. It's the same as though we had money distributed. And then last thing, the adjustment is reduced by the basis of any property distributed, and then we're going to determine whether we can take those losses. Okay, so here's kind of what the equation looks like. So our starting basis, like I said, however, based on all those parameters that we talked about at the start of the chapter, plus any property contributions after formation. So maybe we contributed more to the partnership after the fact. You know, we had our starting contribution, and then 6 months later we contributed something else, right? We're going to add that to our basis. That's going to increase our basis. Then we're going to add our ordinary income, so that box 1. ordinary income is gonna, that's on our K1. Remember, our K1 is gonna look different from somebody else's K1. It's all on an individual basis. We're gonna add what's in box 1 on the K1. Plus, our separately stated income or gain items. So if we had dividends, that's gonna add to our basis. If we had capital gains, short-term or long-term, that's gonna add to our basis as well. Then we get to add our share of partnership liabilities if we have any. Okay, so we're gonna add that into any additional partnership liabilities. So if we already included liabilities up here, we're not gonna include it again, right? So like at the start, if we had those liabilities that each partner took on a portion, we're not gonna add that again. It's just any additional liabilities that we took on. Then we're gonna subtract items. The basis of any property distributed, cash or physical property. So distributions can take place, usually they're cash. That's the most common type of distribution, but it could be some like an asset that the partnership owned, and then it's distributed to the partner, okay? So, but can't go below 0. Once we've done like all this calculation, basis of property distributed, we're still gonna kind of keep a running tally here. We can't go below 0. If we still have some basis left, we can subtract then the partner share of partnership loss. So if that box 1 was a negative number, now we can subtract that up to 0 basis. If it gets us to below 0 basis, we can't take more than that, right? Then if we still have some basis left, we're gonna subtract our share of separately stated loss or expense items. So capital losses, 179 expense, that sort of thing, things that we got a tax benefit from. Then if there's any basis left, we're gonna subtract the release of any partnership liability. So if we don't have a liability anymore, if we've been released from that, that's gonna come next and last, okay? So this is the order with which we would do that calculation. Let's look at an example here. The basis that remains is used for the determination of any deductible losses from the partnership. So this would determine whether if we get a tax deduction for it. Okay, because if it's a negative and we have basis to cover it, that means that we're gonna get a tax advantage. If we have a $50,000 loss in our partnership and we have basis to cover that, that means that $50,000 is gonna reduce the other income on our tax return. So if I had wages of $100,000, now my taxable income is $50,000, not the $100,000. I'm gonna get a big tax benefit from that, okay? So if we still have basis, then we can take that loss. So now let's look at the example. We've got Allison. She has a basis of $5,000 at the beginning of the year. She received $3,000 in cash distribution. So the partnership gave her $3,000. Again, remember, that's just like pulling money out of your savings account. That's not, as long as you have basis, as long as you have a positive balance in your account, that's just like pulling money out of your savings account. So she got a $3,000 cash distribution. Her share of income that's on her K1, that top line, that box 1, is $2,500. She's gonna pay tax on that. That paying tax on it increases her basis. She receives a land distribution with a basis of $4,000. Fair market value of that land is $10,000. So just like the basis transfers, if it's a piece of property and the basis transfers from the partner to the partnership when it's donated, same thing occurs if it's given from the partnership to the partner. So we're still gonna use the basis, not the fair market value. okay? So, this is the calculation, beginning basis 5,000, and in that order, so we're gonna subtract her share of income, 2,500, we're gonna add her share of income, 2,500. She had a cash distribution, that cash out of 3,000, and then a land distribution of 4,000, not the 10,000. Her ending basis in the partnership is $500. Well, why isn't it's worth $10,000, why isn't that distribution $10,000? Well, the reason is because that transaction hasn't completed yet. If she then turns around and sells that land, now she's gonna have a gain of $6,000, but she hasn't sold it, it's still hers, okay? So she still owns it at that point. So it's gonna be the 4,000 basis just transfers, okay? From one to the next. So here is, so the K1, is it here? No, K1 must be on a different page. Exhibit 14-2. Okay, so they're using this K1 to show what the basis adjustment would be. They're gonna give us what the starting basis is. We would add ordinary business income. We are not gonna add the guaranteed payments. That is not going to increase basis and it's not going to decrease basis. Actually, it does both. It increases basis and it decreases basis, but it ends up to be 0. The reason it does both is they got the 42,000, cool, but then they had to pay tax on the 42,000. So receiving the 42,000 increases the basis. Having to pay tax on it then decreases the basis. So it's a wash. So we don't include the guaranteed payments. Dividends though, we're gonna add that $1,100 of dividends. So let's see here. Marker's still back here. I don't know what the beginning basis is that they've come up with, so I'm not gonna add that right now. We'll put that in when we look at, so. That's something. Income is 60, 450. Oh, and I can't go back. I can't remember the order off the top
I've
of my
got
head.
it pulled up if you want. Share of dividends is next.
Okay, so we've got 11 income plus dividends. 1,100,
Short-term capital gains.
short-term and long-term though, right?
Yeah, they have it listed separately, but yeah.
Okay, so we've got our capital gains, we'll just call them capital gains. So $1,000. Right? We also have a 1231 gain of 115. All of these are additions here,
And then
and the other income,
that's it.
is 2,600. And then this is the one where they were supposed to have a 179 in here.
Yeah, in the example, it says charitable contributions minus 2,600. Section 179, expense minus 10,600.
Okay, so this is,
But a lot of these numbers aren't matching up with your form anyway.
this should have been here.
Yeah.
2,600, if that's a charitable contribution, should have been
Mhm.
there.
Yeah.
And the 179 should have been there. So there's a problem with this. But, okay, so let's just say that this is charity. And that's going to reduce basis whether they got to take it or not. They may not get to take this. If they don't itemize their deductions, they're not gonna get a tax benefit from it, but it's still gonna reduce their basis. And then 179, how much was it?
This problem says 10,600. I don't know if it's different on your form.
And then we had a distribution of 26,000. But if we look at the order, let's see, let's go back to the
time, like the ordinary income's different, the short-term capital gains was different, so.
Oh, and this is
all
to,
over.
so this is before we determine whether or not the 26,000. Alright, so 10,600 and then that gets us, oh, they have a beginning basis of 22,000? They just gave us that. We didn't calculate that. So when we get to this point, and I know it's gonna be slightly different, so it's gonna be 71, 585? No, 595. No, 605. Cause this is 115. If you look at the K1, it was 115, it wasn't 105, they've got 105 here. So 71,605. Now we can subtract, let's look at the order here. So we calculated that basis. Now we also have to subtract the basis of cash, that distribution, which was 26,000, which they didn't do in the calculation here. 26,000. None of this distribution is going to be taxable to them because they've got $71,605 in the bank. They're just withdrawing money that they have from the bank, essentially, the bank. 605, 6, so 40, this is their ending basis. 45,605. They didn't, like I said, they didn't subtract the $26,000 distribution that was listed on the K1. Cash distribution that they received. So next year, that's gonna be our beginning basis. And we'll go through this whole calculation again. So if, let's just say that this was, well, do they give us an example? Let's just say that this was $126,000 cash distribution. If that's the case, our ending basis is gonna be 0. And the difference between these two, we have a what's 126, 605, 395, 26 plus 29 is 55. Is that the difference between those two?
54.
They're gonna have to pay tax on, this will be considered a dividend. $54,395 dividend. If that distribution was $126,000. As now they're overdrawn, in order to correct that, they have to pay tax on it. So they didn't include the liabilities in the basis, even though there are liabilities. Most tax preparers would calculate the basis but ignore the liability implications. Liabilities are considered only if the increase in basis is necessary in order to deduct a loss from the partnership. So liability level of the partnership is always changing and it's kind of difficult to calculate. If they, so in our example, this, I'm pretending they don't have those liabilities, but if they did have those liabilities, then we'd be able to use this basis, but then these liabilities would be brought down to zero. And it sounds weird. Their basis in those liabilities is now zero. So it just reduces now when those liabilities are collected, they're gonna have a tax on that. Ultimately, that's gonna add to their taxable basis when they sell it, so don't worry too much about that, but that's just kind of a FYI. Main things to remember here, this equation, the things that increase it and decrease it, that basis, and the fact that it can't go below zero. It's not allowed to go below zero. Questions?